The Intellia Therapeutics Inc. stock, NTLA, is currently trading at $12.405 as of 12:38:53 p.m. Eastern Time on October 30th, 2025, reflecting a significant intraday drop of minus 0.715 cents, which translates to a slide of roughly minus 5.45%. The immediate reaction to seeing this kind of steep daily drop in a high-profile biotech like Intellia, which has been one of the foundational names in the CRISPR gene editing space, might be a quick gut-check panic, especially for those who view it primarily as a pure-play growth story in medical technology. The common expectation from investors closely following the gene editing sector is that any day without blockbuster trial news or a major partnership should at least see the stock hold steady, resting on the promise of its platform. But today's sharp decline rips a hole in that stable expectation, forcing a deeper, more concerning look at the underlying reality, a major clinical setback. The true insight here, and the immediate point that shatters the expectation of smooth sailing, is that this drop isn't just routine volatility. It is a direct and severe reaction to the news of a clinical hold placed by the U.S. Food and Drug Administration on the Phase 3 magnitude trials for Nexazurin Ziclumeran, or Nexz, one of the company's most advanced and anticipated gene editing therapies. This is not a slight delay or a minor data miss. An FDA clinical hold stemming from a patient safety event, specifically a reported serious liver safety issue, is a high-stakes event that completely resets the clock on a development program. The general belief among the faithful followers of Intellia Therapeutics stock is that the CRISPR-Cas9 platform itself is so transformative that success is a matter of when, not if. They see a technology that can theoretically fix genetic errors at their source, giving Intellia a seemingly insurmountable lead in treating inherited diseases like transthyretin amyloidosis, or ATTR, which Nexz is designed to address. This hopeful narrative is what buoyed the stock even through periods of high cash burn and negative earnings per share, evidenced by the consensus analyst rating that was leaning hold, but with a significant number of buy ratings and some lofty long-term price targets, reflecting optimism about the pipeline. But the reality is far more complex and fragile. The contrarian view, which this news now strongly validates, is that gene editing is an amazing science, but an incredibly difficult medical practice. Delivering a gene-editing payload in vivo, meaning inside the patient's body, is an immense technical challenge, and even the smallest off-target effect or systemic reaction can lead to a serious adverse event, as we've now seen. This clinical hold shifts the narrative from one of inevitable success to one dominated by regulatory risk, safety concerns, and an elongated timeline, which directly impacts the valuation models used by Fidelity, Interactive Brokers, and even self-investing accounts on the Robinhood app that had positioned NTLA as a long-term growth play. Breaking down the immediate market movement, the sheer volume of trades today, which is already well over 8 million shares, dwarfs the 90-day average, signaling a significant institutional and retail sell-off. This massive trading volume confirms that the market is treating the clinical hold with the utmost seriousness. The immediate sell-off is likely driven by short-term focused hedge funds and traders who use platforms like the Interactive Brokers trading platform for high-velocity, news-driven adjustments, quickly de-risking their positions. We've also seen analysts immediately respond, with some firms like Baird drastically lowering their price targets, citing concerns over the timeline extension, estimated to be at least 2 to 3 months to restart the study, and the resulting pressure on the company's cash runway, which increases the risk of shareholder dilution. This type of institutional repositioning, where larger players rapidly adjust their stance, exerts tremendous downward pressure that far outweighs any incremental positive news. The stock's 52-week high was $28.25, and seeing it currently near its 52-week low of $5.90, this latest news solidifies the bear case that the gene editing space is highly volatile and extremely sensitive to clinical data. The institutional ownership percentage, which is high for a biotech at nearly 89%, suggests that this is not just a retail trade. Major funds, the big players who utilize sophisticated investment help and wealth management services, are making moves. The latest 13F filings show a mixed bag, with some like Baker Bros adding shares in the previous quarter, a classic biotech bet, while others like Capital International Investors and Citadel Advisors significantly removed shares, indicating a pre-existing divergence in opinion that this new data point now resolves strongly in favor of the cautious or bearish camp. The fact that a single, high-profile safety event can wipe out such a significant portion of the company's valuation is a stark reminder of the binary nature of drug development. To understand the core business of Intellia Therapeutics, we need to look beyond the trading screen and into the science. Intellia is a clinical-stage biotech company focused on developing therapies using the revolutionary, yet now clearly volatile, CRISPR-Cas9 gene editing system. Their business model revolves around the promise of in vivo and ex vivo therapies. The former, in vivo, is where the gene editing machinery is delivered directly into the patient's body to make a correction, and the now-held NextZ program for ATTR amyloidosis is the flagship example of this. The latter, ex vivo, involves editing cells outside the body and then reinfusing them, such as their programs for engineered cell therapies. Their long-term success is predicated on two things: the technical capability of their modular gene editing platform to target specific genes accurately and safely, and the strength of their intellectual property portfolio around CRISPR. They don't generate significant revenue from product sales yet. Their operational revenue, which was around $14.5 million in the last reported quarter, primarily comes from strategic research and development collaborations, notably with a powerhouse like Regeneron, a partnership that underlines the validation of their core technology, but also represents a key portion of their non-dilutive funding. The sheer cost of research and development remains a massive headwind, with the company consistently reporting substantial net losses, a financial reality that gets amplified every time a costly late-stage trial faces a months-long delay or an FDA hold. Their quarterly earnings per share has been negative, as is typical for a clinical-stage biotech, and the market understands this. However, the expectation of eventual massive profitability is what has traditionally sustained the valuation, and that expectation is what is being tested right now. Looking ahead, the future outlook for Intellia is now dominated by the response to this clinical hold. The immediate catalyst will be the issuance of the formal clinical hold letter from the FDA, which is expected within 30 days of the company's announcement. This letter will detail the specific issues and requirements for lifting the hold, essentially providing the blueprint for the company's next steps. The management team, which includes highly respected figures from the pharma world, must then articulate a clear and convincing strategy to resume the magnitude trials. This could involve protocol amendments, a reduced patient dose, or implementing more frequent, rigorous patient monitoring. The market will be looking for a rapid and authoritative response that minimizes the perceived long-term damage. Beyond NextZ, the performance of the rest of their pipeline is suddenly under the microscope. Their program for hereditary angioedema, HAE, is a key asset, and any positive data or advancement there could serve as a much-needed counterbalance to the NextZ setback. The ultimate opportunity for Intellia remains the potential for a one-time functional cure for debilitating genetic diseases, a truly massive addressable market. The risk, which has manifested today, is that the technical complexity and regulatory scrutiny of gene editing create an incredibly long, expensive, and high failure rate path to market. The expectation was that Intellia had largely navigated the early safety hurdles. The reality is that major safety events can occur even in Phase 3. For an individual brokerage investor trying to balance their allocation, this situation underscores the importance of proper diversification, perhaps using a mix of individual stocks like Tesla stock and Nvidia stock, alongside broader exposure via Fidelity ETFs or Fidelity mutual funds, rather than going all in on a single high-risk biotech play, Even professional services offered by Fidelity Wealth Management or a Schwab Intelligent Portfolio would flag this stock as having an extremely high-risk profile, and for good reason. It's a moment of truth for the gene editing promise. The core insight today is that the market's expectation of Intellia Therapeutics stock marching inevitably toward a first-in-class, multi-billion-dollar therapeutic product has collided head-on with the cold reality of clinical drug development. The immediate drop is the market pricing in the non-zero probability of the Nexi program being materially delayed, if not permanently derailed, and the subsequent hit to the company's credibility and cash runway. We've seen significant institutional volume confirming the flight to safety. This is a crucial teaching moment for anyone involved in online investment or self-investing in biotech, no matter